We've got Dr. Sachchidanand Shukla joining us, Chief Economist, Mahindra and Mahindra. Good morning, Sachchidanand. Great to have you with us, as always. Let's start off with discussing, how the rural economy was largely unaffected due to the second wave. Demand was intact. Now, going forward, while it was largely not impacted the first time around, the second time, what do you feel has been the impact? How soon do you feel will bounce back? And specifically, if we were to look at the rural segment.
So actually, if you look at what's happened when we compare the first wave versus the second wave, the economy as a whole, and then I'll come to rural. I think what you're seeing right now is faster than expected regulatory relaxations. This has led to activity really rebounding very, very fast. So as it fell or as it cracked, it has come back up again. So if I look at, say, things like GST, e-way bill, look at Google mobility data, especially on retail, especially on recreation, etc. It's actually bounced back pretty fast, and it has taken most people by surprise. So I think we should look at May probably as a trough for the economic impact of the second wave. Most of the indicators that we are tracking indicate that the recovery is going to be much faster, but we must bear in mind that the economy is really rebooting, right? And that too in safe mode. And there could be regional variations, like, for instance, the state of Maharashtra. We have seen some tightening of restrictions because of the Delta Plus concerns. And I think one important distinction that I want to make here is, while India's growth was impacted much harder, for example, the global GDP or the global growth continued to really boom in the first half of this fiscal. And that is really going to be an important indicator going forward. Coming back to the rural economy, I think the impact on lives has been devastating. There is absolutely no doubt about it. But the impact on livelihoods has been contained largely because the agri-linked cash flows are relatively stable. The outlook over there is much, say, better. But the non-agri cash flows have been impacted. But like I said, as the regulatory restrictions get eased, we are seeing a very fast rebound across most states. But we will continue to really get hampered by these regional variations. For example, the Northeast, the southern states, for example, are still reeling under the impact. So I think as we go forward, we will have to be cognizant of these relative pace of easing across states, across regions.
Okay, if we take a look at inflation as well, now prices for petrol, diesel, other commodities has all gone up and expected to continue. WPI is now close to 13%, and on last check, retail inflation is also breaching about 6% in May. So what's your outlook and, consequently on the Indian economy as well? Do you see the RBI addressing this and gradual change in accommodative stance going forward? Do you still see it focusing on recovery at this point? How do you see things evolving from here?
I think when I take cues from global central banks, they themselves are finding it difficult to give definitive directions to markets in terms of the inflationary outlook. We have just seen the Fed really recalibrate whatever it said on inflation, and the market is anticipating some action on interest rates much faster than before. When I look at RBI, when I look at India's inflation variables, CPI or WPI, there is some element of regulatory component over there. For example, the fuel prices. This is something that the government is doing in a calibrated fashion. This is a calculated bet, given that the government revenues are really constrained. Having said that, I think there is a definitive component of imported inflation that we are seeing. This is likely to continue to impact, say, margins of most manufacturing companies. But like I said, even the RBI has made it abundantly clear that it will see through some of these components of inflation, be it commodity-induced inflation, or supply-driven inflation, I think they are likely to see through those as transitory, and they remain very focused on salvaging growth at this point in time. I just wanted to point out a couple of things. If you look at the private final consumption in F21, at constant prices, it was about, say, 75 lakh crore, which is just about 1 lakh crore higher than what we saw in FY18, right? If I look at, say, GFCF, even that has remained more or less stagnant at about 42 lakh crore. So given the fact that these two big engines of growth are reeling under the impact even 8 quarters after, say, FY 18-19, I don't really see why the RBI should be in a hurry to act on inflation or some of these nominal variables that you are likely to see on prices.
Sure. Sachchidanand, just on the global point, when the Fed does increase interest rates, how substantial do you think, A, is the risk at this juncture in terms of the impact that it could have on the Indian economy, and more importantly, a stance change from central banks across the globe?
So if you look at the concerns, I think people really peg their outlook based on the fact that during the taper tantrum, rupee depreciated by more than 30% when Bernanke spoke about just the possibility of rate hikes. This time around, I think things are a bit different. The Fed is very, very careful. They have learned their lessons. They will not really rock the boat. And at the same time, while we need to be cognizant of some of these push factors, for example, the Fed or some of the large central banks really recalibrating their position on interest rates and inflation, I think one important factor that we need to be focused on is the pull factors that we have. So, for example, if you look at recent literature, it's been pointed out that growth differential is going to be the critical factor going forward. If you look at India's response, the government has been very, very tactical. It has actually also imparted some sort of reform push. The supply side, we've seen agriculture, labor reforms, the PLI scheme, etc. And therefore, I think, given the fact that the government of India has not really thrown money at the problem like some of the large central banks or some of the large economies in the world, and also there is a bit of monetary policy credibility built around through that flexible inflation targeting framework. I think India's relative growth or the potential growth rate or the growth differential that we keep talking about, as long as that remains intact, I don't really see that big an impact on India's, say, economy or flows. So financial variables, of course, global sentiment changes or commodity prices like crude oil would impact in India a bit. But if you look at what's happened in the last, say, 12 or 18 months, the rupee has been rock solid. And this is in part due to some of these pull factors that I spoke about. So there has been relative financial stability. Financial conditions have been stable. The forex reserves, if you look at what we've accumulated, close to about $98 billion, of which 40% have accrued because of the FPI flows. And therefore, I think if I look at it in terms of risks and reward, there is a danger of exogenous global shock. But at the same time, given the kind of wealth effect, I mean, look at the markets, the way they've bounced back. It has imparted some sort of wealth effect. INR has been stable. We've built up the FX reserves and the balance sheet recession that we were reeling under. So look at corporate sector. Interest coverage ratios more than doubled despite COVID. Cost of equities come down, and that has laid the foundation of probably the next leg. And corporate balance sheets are now in a much better shape. So I would say that yes, there are risks, but we seem to be on a much stronger footing as compared to the shocks that people compare it with.
Sure. But purely in terms of equity markets, could it also lead perhaps when the Fed does choose to hike rates, lead to perhaps a substantial capital pullout from India equities?
Absolutely. I think one thing that we all need to remember is that India does not just import commodities. We are a big importer of capital. Whenever things change at the margin, and US is the source of funds globally, especially the kind that flows into the Indian economy. Any relative changes, say vis-a-vis interest rate differential, growth differential, or the central bank stance over there, there is always this risk of some impact on flows. And like I said, we have seen these bouts of money flowing out. Right now, if you look at the kind of, share portfolio investors have, I think it is close to about 27, 28% as compared to the average of 19 odd percent. We can definitely expect some money to really flow back. But again, I think it is going to be a consideration as to where the economy is going to be in the medium term. So short-term impact, I agree, there could be money that can be pulled out. But over time, I think India's growth and interest rate differential will be the critical factors, and money will come back as it goes out. So, I mean, we have seen that. Just to give you an example, February, May 20, portfolio investors withdrew about $18 billion, right? But thereafter, we saw money coming back, $38 billion came back in FY21. So I think short term, yes, but medium to long term, it will really depend on how the government navigates the India growth story from a medium term perspective.
Okay, what about the income divide that we've seen, between the rich and the poor in India, Sachchidanand? And do you feel that this is, possibly somewhat attributed to global liquidity into India? How do you see this, continue? As in, do you see some reduction in the divide, or do you see this continuing? I mean, how is this going to, evolve, and is it a cause of concern?
Yes, I think inequality has been a concern globally as well as in India. In India, it manifests into regional inequalities, class-related inequalities, etc., etc. So I think what a pandemic does typically is it does accentuate the differences that are there in the economy. The strong get stronger, and the weak get hit harder. And then this is also a biological phenomenon, as you know. Any pandemic, if you look back in history, manifests in a way in which the strong emerge stronger and the weak are hit much harder. So I think looking at the inequality bit, there is this urban-rural divide in India. There is this top rung of companies that have benefited or are likely to benefit and emerge stronger. The example that I gave you in terms of interest coverage ratio, or the ability to borrow cheap. For example, Indian companies were able to borrow at less than 3% during June to August of last year. I can't remember any time wherein Indian corporates have been able to borrow at less than 3%. Similarly, those with stronger individuals with stronger balance sheets, repayment capabilities, can really get a housing loan at less than 7%, which is, I think, if I go back to early 2000s, we didn't really see interest rates that low. So I think it does naturally impart some sort of a benefit to the stronger or people who are better off. And I think this is going to be a concern, not just for the Indian economy, but also a global phenomenon. We are seeing that manifest in vaccine inequity, social, regional inequalities, etc. So I think this is something that we'll continue to grapple with over the medium term. Governments are looking at inclusive policies. In India, we've seen several policies aimed at really bridging this divide. But I think it is going to be a tough ask for any government to bridge this kind of divide, especially the inequality that you're talking about.
All right, we'll leave it there. Thanks so much for joining us this morning. Great speaking with you, as always. We're going to take a very quick break. When we come back, we'll also be joined by the management of Godrej Agri.